Hi there, Etoro. As I mentioned last week, this week is going to be something a little bit different. I wanted to talk about my portfolio in a little bit more detail, my strategy, and something about portfolio construction. So without further ado, let's take a look. I'm going to walk through a few of the slides that I include in my quarterly copier updates, so apologies if you've seen these before, but I think that they bear repeating within this context. Now, whether you're investing in a particular stock, an ETF, or copying someone on Etoro, I think that it's important to have the right expectations about the performance and the behavior of that asset whilst you're holding it as an investment. In terms of my own investment expectations, I expect my portfolio to be more volatile than the broader market. I believe that over the long term, a multi-year time frame, my returns will also be higher than the broader market. So what this means is that in down years, my portfolio could be lower than broad-based indices, particularly in the US. And in bull years, my portfolio returns will exceed those same indices. In terms of my investment strategy, so I break it down into these 4 pillars. I'm not going to go through all of them at the moment, but I did want to touch on a few of the points. So my investment approach tends to be long-term, so at least months, but usually years. Volatility isn't a huge concern for me, and I'll talk about that a little bit later on. My portfolio tends to be concentrated, and although I have 30 different assets in my portfolio, a lot of those assets sit within the same sectors or industry groups. I think that in order to achieve superior returns, your portfolio needs to be concentrated in some way. Otherwise, you might as well just go out and buy the indices. Whenever I invest in any particular asset, I look at it as though I am buying that entire company. And so I do all the same kind of due diligence that I would in those cases, although in a lot of these cases I can't meet the owners personally, so I need to do other types of investigations around the people that run those businesses. And finally, even though I talk about macroeconomics quite a lot, and I feel like I've got a good grasp of macroeconomics, it doesn't feature a lot in my decision to invest in a particular business, most of the time anyway. There are just too many variables when it comes to macroeconomics, too many things that could happen very suddenly and change the outlook entirely. I mean, a recent example is look at the slightly warmer winter through Europe. That's gone a long way to changing investor sentiment from super bearish to slightly more bullish. Instead, my approach is to understand businesses. So at the bottom-up fundamentals of a company, understanding their books, but also their product strategy, their business strategy, the business model, their competitors, the people that lead those companies. Now, that's not to say that you can't make money as a macro trader. There are many people that do very well as macro traders. But my opinion on this is very similar to lots of other successful investors too. Probably the most famous of which is Warren Buffett, who's spoken about this many times. And here's one such clip.
All of these economists with 160 IQs that spend their life studying it, can you name me one super wealthy economist that's ever made money out of securities? You know, I mean, just go down the list.
No.
No, Keynes actually, in his early years, tried to make money in stocks by predicting what business would do, and he gave it up. And then he went over to a Graham-type approach. I mean, it's very interesting to read his history on this, because he thought he could, by looking at various economic variables, pick what he called the credit cycle and make a lot of money, and he went broke a couple times in doing it, had to borrow from people. And then he settled on buying good businesses cheap that he understood and concentrating his investments, and he did very well. It's an interesting history. But if you look at the whole history of them, you know, they don't make a lot of money buying and selling stocks, but people who buy and sell stocks listen to them, which is, I have a little trouble with that.
So just how concentrated is my portfolio? Well, like I said, I've got a number of different companies, 30 different companies, 30 plus companies in the portfolio, but I tend to focus on particular sectors or industries. So this is bullsheet.me, and you can see on the right, the S&P 500 contains stocks in all of these different sectors. However, you can see that in my portfolio, these white lines, that I don't own anything at the moment in consumer defensive, healthcare, utilities, or energy. Instead, my purchases are concentrated in these other sectors. If we scroll down a little bit, we can also see that nearly 75% of my portfolio is invested in just 3 sectors: consumer cyclical, technology, and communication services. A very commonly held belief in the finance world and an investment is that risk can be measured by volatility, and I do not hold this same belief. If you really think about it, why should the degree to which the stock price of a company moves determine the risk level of investing in that particular company? If I pick just one example, looking at Microsoft back over the past 20 or so years, I think everyone can agree that Microsoft is a very high quality company. And yet we can see that over the past 22 years or so, it has been quite volatile in terms of the price action. There have been more than a dozen times when the stock has been down in double digits, sometimes down quite significantly, most recently down 36% from its recent all-time high. Now you might think that I'm exhibiting some hindsight bias here, and maybe I am. But if we go back through the historical numbers, we can also see that the PE ratio, which is this dark blue line over here, for Microsoft has been in the single-digit numbers at some points and in the low double-digit numbers for many, many years, whilst at the same time performing very well by a number of measures. One such example is the free cash flow margin, which I have done here, which you can see these glorious percentages that Microsoft has held through this entire period. But other things such as EPS growth are also pretty decent for Microsoft. I think that through this entire period, there have been very strong signs that Microsoft is a very high quality company. But this has not stopped the stock from being incredibly volatile through this 2-decade period. Volatility does not equal risk. I think a much better definition of risk is the risk of losing your money, which makes sense as an investor. And for me, there are a few key factors in determining whether you are at risk of losing your money. The first of these is that you haven't done the hard work. You haven't done the investigation. You haven't crunched the numbers. The second is that you made a mistake somewhere along the lines. And everyone is likely to make at least a few mistakes every year. The third is that something outside of your control happens. There are lots of small examples of this, but a large recent example is the pandemic and how it crushed certain companies, for example, travel companies. And the fourth is that you let your emotions get the best of you. Now, some of these things you can't control, right? So if something outside of your control happens, it's literally outside of your control. And making mistakes, you can try to not make mistakes. Maybe you'll make fewer mistakes, but there still will be mistakes in what you do. However, you can control doing the hard work. You can learn what that means, and then you can execute on that plan. But probably the most difficult one to control is not letting your emotions get the best of you. So I think what people really mean when they say that volatility equals risk is that volatility means that people let their emotions get the best of them when there is volatility and they behave in ways that they shouldn't. It's very difficult to learn to control your emotions, to understand yourself and control your emotions when you are an investor. But with time, you learn from the experiences and you can grow your discipline in order to control the way that you behave. Moving on to portfolio construction, I'm going to have to keep this fairly high level, otherwise it could be a 2-hour long video. But my portfolio tends to be made up of very large companies. The bulk of it is very large companies with a number of smaller companies around those. So a kind of core and satellite approach to investment. You can see that if I order the companies in my portfolio by market cap, there are 2 of them that are trillion-dollar companies and a number that have market caps in the hundreds of billions or tens of billions. There are just a handful that are sitting north of $500 million. The reason for this is that larger companies tend to be, first of all, more diversified. They have more services or product sets that they're offering. So if something is going wrong in one particular area, they can weather that storm. They also have much deeper pockets. They have access to more debt, more types of debt, so they can weather big storms that affect the entire industry or the entire economy. The reason that I want those smaller companies is because large companies cannot grow as quickly as smaller companies. So the companies that I tend to invest in that are smaller, I believe can be the leaders of the next few years. Whilst a large company can maybe grow 10, 20, 30% if you're very lucky, smaller companies can sometimes do 50% growth for a few years. Almost all companies in my portfolio are growth companies, but growth doesn't always mean tech, by the way. If we look at this table, and I apologize, it is a little blurry, we're focusing on the bottom right-hand quadrant. So those are the stock performances over the last 20 years, although I think this was maybe 2 or 3 years ago. You can see that the best performing stocks are not necessarily technology companies. In fact, in the top 10, we only have Apple and Nvidia, who are core technology companies. At the top, we have a company that makes sweet drinks. Historically, growth industries have been automobiles, carpets, utilities, etc. Growth industries tend to be those industries that are new, that are making a big splash, that can be high margin because people can demand a premium. But then over time, competition increases, margins shrink, and then some other leaders come along. Another thing to bear in mind is this debate of growth versus value stocks. It's a bit of a silly debate, in my opinion. Growth companies can be value companies. In fact, at several points in time, companies such as Apple and Google have been value companies. They've been cheap companies given the amount of growth that they would experience over their lifetime. So what do I think is my edge when it comes to investments? Well, I'm going to talk about this in a roundabout way. So I think that investing and personal health are very similar in a number of ways. There's no secret to being healthy. Everyone knows what to do. You have to have a varied diet, you shouldn't eat too much, and you need to exercise. Very simple. But the gap between the theory and the execution of the theory tend to be where most people fall down. The same is the case in investing. There is no secret. Warren Buffett and other great investors put this information out there all the time for people to learn from. However, the gap, the chasm between understanding what you should do and actually doing it is quite large. The reason for this, I think, is quite apparent in the tweets that I've had up on screen for a while now. You've probably read through it already. So this particular person on Twitter, they asked the same question, but in two slightly different ways. The first version of the question was, would you consider doubling your investment in 3 years a good trade? And almost everyone, 84% of the people, agreed. However, the second version, which they actually asked first, was if you buy stock for $100 and it falls to $50 before rising to $200 3 years later, did you make a bad trade? Now in this case, 20% fewer people agreed with the statement, despite it being the same question as the first. I think the reason for this is quite simple. When people hear about the destination, they're enthusiastic. They want to be there. Do you want to be thin? Do you want to be healthy? Sure, why not? Do you want to double your money in 2 years? Sounds fantastic. But when you talk about the elements of the journey to get there, then people start thinking about the pain and effort involved. So now they know about the destination, but the journey has started to put them off a little bit. They don't want to experience that pain. They don't want to put in that effort. I think that part of my edge as an investor, besides doing the hard graft and loving investment, is that I understand that in order to achieve my goals, there's going to be a bit of a journey to go on. There are going to be great times, but there's also going to be some pain involved. Not only do I know this, I have the stomach to endure that pain in order to achieve those results. Another quick example to walk through is the performance of the NASDAQ 100 versus the S&P 500 since 1986 to 2022, so a little bit more than 35 years. The end result, the destination in this case, would have been an average return on the NASDAQ of 17.5%, whilst the S&P 500 put in a return of, let's call it 12% on average. Now, if you told Joe Public that this is the kind of average return that they could achieve over this period, I'm sure they'd be very excited, throwing their money at you. However, the journey has been quite a lot more volatile. So if we look at the NASDAQ 100, you can see just by looking at the charts that it is a lot more volatile than the S&P 500, particularly this most recent tumble, but that's because this chart isn't logarithmic. The journey in this case would have seen a number of very good years, but you also would have seen 3 years with greater than 30% decline. That is one hell of a grind to endure in an investment. In 2008, there was a fall of over 40% in the NASDAQ 100. And then most recently, in 2022, a fall of 33%. Now, it is my opinion that the NASDAQ 100 will continue to outperform the S&P 500 over the next 1 to 2 decades. But I also have no doubt that the journey in that investment will be very difficult to endure at some points. I believe that my portfolio is to the NASDAQ 100 as the NASDAQ 100 is to the S&P 500. Particularly when it comes to levels of volatility and also returns. Now, if you go look at my stats on Etoro, I think that will be the case for most years. Last year, the NASDAQ 100 had a terrible year, minus 33% down. My portfolio was 9% below that. But I also expect in the coming years for my portfolio to end those years higher than the NASDAQ 100. So how has my portfolio held up? Is my strategy working? Well, the NASDAQ 100 since March 2015 until the end of last year has provided a decent return of 150%. My portfolio over the same period has given a return of 289%. The theory of how to be a successful investor, I think, is widely understood. However, bridging the gap between theory and execution is another thing entirely. I know that 2022 was a difficult year for my portfolio and therefore my copiers, and there will be such years in the future. But in the long term, I think that my portfolio will continue to outperform the likes of the NASDAQ and S&P 500. I know that this video has been fairly high level, but I hope that it gives you a bit more insight into my investing process and strategy. Later this week, I will also be doing my quarterly review video, and I'll share that with everyone on Etoro. I hope you have a good week. Goodbye.